Hi and welcome to today's video on slippage. Slippage can have a significant impact on your trades, especially in volatile markets, high trading volumes, or when liquidity is low. It's a common challenge, particularly for large orders, and can lead to unexpected losses if not managed properly. In this video, we'll explain what slippage is, why it happens, and how you can reduce its impact on your trades. So, what exactly is slippage? Well, slippage occurs when there's a difference between the price a trader expects to execute an order at and the actual price it gets filled. This often happens with market orders where execution takes place at the best available price at that moment, rather than at a preset entry price. Slippage can be either favorable or unfavorable, impacting your potential profit or loss. It's worth noting that while slippage is most commonly associated with Forex, it can also occur in other financial markets, including cryptocurrencies, particularly on decentralized exchanges where liquidity can be low. There are two main types of slippage, negative and positive. Let's start by looking at negative slippage. Negative slippage happens when the price moves against your trade, leading to a loss or smaller profit than expected. For example, you might place a buy at $1.2, but it would execute at $1.5. If the price falls after the execution, you may find yourself at a disadvantage. Positive slippage, on the other hand, occurs when the price moves in your favor, leading to a greater profit. So if you place a buy at 1.2, but it is executed at $1 and the price rises after that, you can make much more profit than initially anticipated. Now, when we're talking about slippage, it is important not to confuse it with spread. While both slippage and spread refer to price differences, they are different concepts. The spread is the difference between the highest price buyers are willing to pay and the lowest price sellers are willing to accept. It's essentially the cost of trading and varies based on market conditions. Spreads can be fixed or floating, with most fluctuating according to market liquidity. Slippage, on the other hand, is the difference between the price you expect when placing an order and the actual price it executes at. So, as I said before, this can happen when there's rapid price movement or low liquidity. It is important to understand the differences, but now as you do, we'll be looking at how you can avoid slippage. Reducing slippage comes down to understanding its causes: rapid price fluctuations, high trading volume, and supply-demand imbalances. Here are three ways to minimize slippage. Be cautious during high volatility periods and news events. Avoid trading during market session changes like the weekend closures. And use limit orders instead of market orders, which can help avoid unexpected price movements. There's also a fourth way to minimize slippage, namely choosing the right broker. After all, brokers act as intermediaries between traders and the global Forex market. Reputable brokers like xChief use advanced technology to speed up order execution, reducing slippage and enhancing overall trade efficiency. To minimize slippage, choose a broker that prioritizes quick orders and offers tools like virtual private servers or VPS for smooth trades. That's it from me for today. I hope you've learned a lot, and I hope to see you again in the next video. Oh, and if you have some tricks for lowering slippage up your sleeve, please share them in the comments below. Thanks, and have a great day.